Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. In today's video, I want to check out and go over a recent press release on one of my favorite funds, HYLD. So of course, I'm talking about the Hamilton Enhanced US Covered Call ETF, what I usually refer to as an all-in-one covered call solution. So this is actually the number one position in my portfolio personally, and I know it's a pretty big position in yours, most probably. So they just came out with a press release that they made changes to HYLD. So the heading of the press release says that they added JEPI, they removed the HBF ETF for higher yield, added diversification, and lower fees. So let's check out what these changes are all about in detail together. Is it good news? Is it bad news? Let's find out right now. All right, everyone, first things first, let's check out the press release together. So I'm on Hamilton's ETF's website here under HYLD. So if you just scroll down, you see the press release right here. And if you click on it, you get the article. And let's go through it together here. So adding the JP Morgan Equity Premium Income ETFs, JEPI, selling the Harvest Brand Leaders Income ETF, HBF. So like Hamilton says here, they added JEPI, they sold HBF because, in our opinion, JEPI offers several advantages as highlighted in the chart below. So they mentioned higher distribution yield, 9.4 versus the 8% of HBF as of October 17th, lower management expense ratio, greater diversification, and lower volatility, which helps HYLD sector mix align closer to the S&P 500. So let's analyze the chart here. It was really cool that they put this. So distribution yield, so it's higher with JEPI right now by 1.4%. The management expense ratio, or management fees, a lot lower here, 75 to 35. The MER is actually 35 on JEPI, and the MER on HBF is 93. So there's savings there for sure. A lot more holdings, 106 stocks in JEPI versus the 20 in HBF. More sectors, which means it's more diversified and less volatility as well. So all wins here. In my opinion, it's a pretty good move. And we'll check out JEPI and HBF in detail in a second here. But going on, that's the big change. But they also made another minor change. Maybe you didn't catch this one. They modestly increased energy and reduced healthcare. So what they did is, same type of deal to try to get closer to the S&P 500. They lowered the HHL position, which is the Harvest Healthcare ETF, by 3% and added a very tiny 3% positions in NXF, which you guys know is definitely my favorite covered call energy ETF by CI. This ETF basically has 16 or 15 rather of the biggest oil and gas companies. So we're talking Suncor, Shell, Canadian Natural, ExxonMobil, Chevron, BP, et cetera, et cetera. So really only the big cap of what you want in energy, but it's only a very small 3% position. So, stronger distributions, reduction in fees, greater diversification. So if we go back to HYLD now and check it out, you could see the sector mix here. So technology is still dominant, which is expected. Technology and healthcare is going to be dominant because it is the US market here that we're trying to replicate, right? The S&P 500. So technology at 30, healthcare still high at 17. And you'll notice that the energy, although they added NXF, is still very low at 5.1, which I find it's good. You got to have some energy. 5% is really, really good in my opinion. So you see the full breakdown here with still the global X ones, QYLD, RYLD, XYLD, has the biggest chunk, and you still have TXF here, which is specifically technology. And here's JEPI right here at 13%, HHL, which is healthcare, at 10.7%, and you have gold at 10%, gold producers rather, and a small little chunk at NXF right now. So really nice yield, by the way. The fund is very, very popular, growing, keeps growing at 232 million. It's actually very close to HDIV already. It's catching up. I think it's going to beat HDIV in AUM very soon, in my opinion. So here's the sector allocation, and still very high in healthcare. I wouldn't worry about the small reduction in HHL because don't forget, RYLD, XYLD, JEPI, they have a huge chunk in healthcare already. And even QYLD, by the way, has like 6% in healthcare. So healthcare is still pretty big. I know it's defensive and you guys like that sector. I like the sector as well. Very hard for us Canadians to get it. So All in all, let's just check out what they swapped out. So they swapped out HBF. What does HBF have? If we look at the portfolio here, it's just basically 20 big cap US companies that have very, very strong brands. Well, 19 are US. HYLD is actually from Netherlands. So you have United Health Group, Apple, Accenture, Alphabet. So Bank of America, Johnson & Johnson, McDonald's, Pepsi, Morgan Stanley. So it's all companies that are definitely going to be one way or another already in the S&P 500, right? So it's not like we're missing out on anything by getting rid of HBF and going into JEPI. JEPI is actually past QYLD by far. It is the number one covered call ETF in the US by far. So you see here that low management fee, just like they said, of 0.35%. If we scroll down, let's check out the stats here. And the first thing you'll notice right away is the astronomical. This fund is huge for a covered call fund to be almost 14 billion. And this fund is actually not even that old. It's pretty incredible. Also, the performance has been really, really good. You see the stellar performance. I haven't seen a covered call ETF perform this well. And what does JEPI do? Well, they basically track the S&P 500 here. So you see here, what does it say? Here it is. Out of the money S&P 500 index calls. So basically it's very similar to XYLD, except it's out of the money. So XYLD is the global X1 here, which is also the S&P 500. So it follows the S&P 500, but it's they have out of the money calls. So a little bit more, there's a strong possibility of getting a little bit of growth here, and probably a little bit less income than XYLD, which is okay. Still higher than HBF. If you click on the portfolio, you'll see the top 10 stocks here, which is all, American blue chip stocks. Go down and you see sector exposure. Now, very, very interesting. If you compare it to XYLD, for example, you see that it kind of replicates the S&P 500, but it's actually a little bit more defensive. It has high consumer staples and higher utilities, whereas it has only 11% in information technology. I found that very, very interesting. So even the sector mix is a little bit more defensive, which is good in my opinion. And if we look at the dividends, you'll see that the dividends have remained stellar, remained very, very consistent, because, market volatility, don't forget guys, helps covered call premiums. They increase. So you could see that increase here. So, it's different every month, just like the global X ones, but very, very high. We're talking about really, really nice yield of pretty much, let's look at the 12-month rolling average. We'll see that somewhere here. So right now, the dividend yield is 13.30, but that's because the premiums are higher. Plus, obviously, this fund went down because the overall market went down. So this is more of an accurate dividend yield here. So you're looking, I would say between 8 and 10, guys. Very, very good dividend yield. But don't forget at HYLD, there is 25% leverage. So you're getting 25% more. So all in all, I applaud Hamilton. I think this was an extremely good case. I mean, they laid it out in black and white here. I mean, it's really a no-brainer. I think it's a really good thing to, at one point, at first I thought, why didn't they just leave HBF and add JEPI? But you know what, the more I think about it, the more I see this, the more it makes sense, because don't forget, JEPI has a lot more exposure and pretty much has the same companies as HBF. Plus, we already have the QYLD, which is NASDAQ 100, XYLD, S&P 500, which pretty much has the, will have these companies as well. So it's not like we're missing out on anything. So all in all, guys, I have to applaud Hamilton. I really agree with this move. It shows me that they're always looking to make the fund better, which is something that I want to see as an investor. Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals. And it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it. So there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website, on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.